How does a stock market work and why should you care? I'm going to go into that here today here at the Heritage Wealth Planning YouTube channel, my friends, because I think a lot of people don't get it. And if they got a general understanding of actually how the stock market works, I think they could make much, much better investment decisions. So I'm hoping to share that with you today. Welcome to Heritage Wealth Planning. Like as always, if you like what you see here, go ahead and subscribe down below, that tiny little button down there. And if you do that, please don't forget to hit the notification bell as well so you're notified for future content. We do a video a day here at the Heritage Wealth Planning YouTube channel, so we definitely want to keep you in the know. All right, so let me back up here, and I'm going to start with a football reference. So this is profootballreference.com. And you might be saying, oh, boy, Josh, you've gone crazy. What does pro football have to do with the stock market? Let's take a look. So we have, 32 teams in the NFL, right? Yeah, 32 teams in the NFL. Each team plays how many games? 16. All right, so we know for a fact at the end of the year, the average team's record is going to be what? Think about it. You got 32 games, 32 teams. Each team plays 16 games. The average team's record is going to be 8-8. You cannot have more wins than losses. You just can't. And not if you have an even number of teams. So in this case, 32 teams, they each play 16 games. The average team in the NFL goes 8-8. That is the market. That is the market, okay? The average is 8-8. Now, what we see here is in 2017, I had written it down, we had 17 teams with a Pro 500 game, a season where they had more wins than losses. So this is 500. Their Buffalo Bills are 9-7. That means they went 563. That's their winning percentage. 563 is above 500. 500 would be the Arizona Cardinals who went 8-8. They had a 500. But we had 17 teams that were above 500 and 14 teams that were below 500. And one team, the Cardinals, are 8-8. You might be saying, well, how could that be? How can you have more teams with above 500 record than you have with less than a 500 record? And the simple reason is because you had this one outlier, the Cleveland Browns, who didn't get a win. They were winless last year. And so when you factor that in, you're saying at the end of the day, because these guys were the outlier, that was able to allow more teams to have a winning record than the average. Even though the average is still 8-8, you still have more teams in this case with a winning record. So in this case, more teams beat the market. More teams beat the market. They had a higher than 500 percentage. And that's how the markets work, though. When the markets work, this is where it's a zero-sum game, is that if someone is going to win in the market by beating the market, inherently someone has to lose. There's just no getting around that. If it's me versus you in the market, we're a market of 2, and I get 100% return, and the average market return is 50%, that inherently means you had to get 0. You lost all your money. Because 100 and 0 is 50%. That's the average return. That's the only way the stock market works. It is a zero-sum game in terms of your ability to beat the market. For you to win, someone else has got to lose. Thus, a zero-sum. Now, to invest in the market, unlike the NFL here, to invest in the market is not a zero-sum game. It's a forever expanding, hopefully, pie. Now, sometimes the pie shrinks, like in 2008. But for me to make money, it doesn't inhibit you from making money at all. Because for me to invest and you to invest, as long as the earnings of United States companies or even international nowadays continue to grow, we can both make money. And that's what the stock market is premised on. It's not premised on some algorithm, some trading schemes or anything like that. It's just simply premised on the ability for the publicly traded companies for which you can own a sliver of, a share, to continue to make money more so than they did the year before and maybe even pay a dividend. That's it. So to beat the market, it is a zero-sum game. To be in the market, we can both do well, all right? And that's so critically important. It doesn't matter if you were able to beat the market or not, because if you were able to, someone else did worse. Now, that someone else who did worse may have still made money, but he did worse than you did because the market averaged 8-8. And that guy only had 7 wins. He still had 7 wins, and you had 9. But for both of us to make money in the market, it doesn't work like that. We can both make money. It's not a zero-sum game to invest in the stock market. It's not. You are literally investing in the companies that you frequent, I guarantee, every single day. And as long as those companies continue to churn out profits by you continuing to frequent them selling products, them coming up with new structures, or new companies like Google. There was no such thing as Google 20 years ago. I guess 25 years ago now. Twitter. I mean, as much as I can't stand Twitter, no one knew what Twitter was 25 years ago. Facebook, all these companies. Now these companies are coming up online. They're taking away other companies that are losing money. Sears is, Pets was a PetSmart, Kmart. All these companies going bankrupt. That's the way it works, though. That is where the zero-sum game comes in. I mean, not the zero-sum game. That is where you can lose money, is that you have too much of your money in Google and Sears and Bethlehem Steel and Blockbuster Video as opposed to new company. That's why I got to be diversified. But just because Sears went bankrupt doesn't mean I have to. I can still make money because the market on average still did 8 and 8. And for me, an 8 and 8 return is based on 8% year over year return, which is not just for me, for the average market, about 8%. Has nothing to do with my ability to beat the market. You don't have to beat the market to make money. And what Jack Bogle from Vanguard shows actually pretty eloquently in his book, Common Sense on Mutual Funds, is if the market average is 8 and 8, but you factor in fees, then the market average is 7 and 9, because the fees take basically essentially a win from the win-loss column, and it takes one win and puts into the loss column, because the fees are what you're paying to beat the market. And because those fees are intuitive for every investment fund that's out there, they actually take away gains from the market. So the average market return net of fees is actually 7 and 9, when the average market itself was 8 and 8. And so that difference in a win and a loss is the fund managers who make money regardless of the market going up and down. Those guys make money all the time. And so what John Bogle says, if we have an index fund, and all we got to do is extrapolate the average returns. We're not trying to beat the market because we don't care. We don't care because it's impossible to beat the market on a consistent basis, and it doesn't mean anything. So if I did 8.15, does that matter? When I could have got 8 just by sitting there drinking tequila all day long? It doesn't matter. So, and if I got 8.15, then you'd inherently have to get 7.85. When if you both would just sat there, we both would have 8%. But on top of that, you factor in the fees that the guy getting 8.15 charge and the fees that the guy getting 7.85 charge. And now they both have less than the market. The market return is 8, but after fees, they both have, let's say, 7.5, which means the average return net of fees is lower than the average return of the market. So not only is the market, to beat the market, a zero-sum game, you have to win and I have to lose. When you factor in fees, we can both lose and both of us have a less return than just the market itself, which is crazy. So you got to think about how investing in stocks work. You are investing in companies that are growing their earnings and maybe again paying dividends. That's it. Has nothing to do with trading. Has nothing to do with Warren Buffett. Has nothing to do with CNBC. I am investing in companies that are increasing earnings and maybe paying a dividend. That is it. I'm spreading my investments, my risk out to many, many companies. That way, if I have a Sears, hopefully it'll be offset by a Google. All right. And that's market. You don't have to worry about if I'm the best investor since dawn or if I'm the worst investor since dawn. The average investor after fees does worse than the average market because the fees take away returns. Don't let that be you, which is why I've been harping on the index funds, harping on the TSPs and whatnot. Just because some guy or lady says, I beat the market, don't care. For you to beat the market, that means someone had to lose the market. We don't know who that person is in advance. If it's going to be you or me, who's going to be the loser or the winner, we don't know. And because we don't know, because we can't predict it, and because fees can make us both losers relative to the average of the market, it better not even play that game. Why be a loser when we could just be average and make money? We could be a loser, pay a significant amount of fees, and then both of us, you and I, even though you beat the market before fees, but after fees, you lost the market, as did I. Because again, for you to beat the market, I have to lose. For you to beat the market and then have your fees on top of that, you could lose to the market and I could lose to the market, even though the market is just you and I. I know it's crazy when you think about it. But don't get caught up in that stuff. The only thing you care about is the companies you are frequenting making money. If they are, then be a stock investor. Absolutely. If you think the companies you're frequenting aren't making money and that they'll never do so because of Obama, because of Trump or whoever, Reagan or Clinton, then you probably ought not to be in the market. I would say that's silly because we are growing an economy under Obama did, under Clinton did, under Reagan did, under Trump does. The markets do grow. Companies do make money. New companies spring out all the time. Even if the old companies, Sears and Blockbuster and Bethlehem Steel, are no longer with us, there's a company to replace it who's taking advantage of inefficiencies in the market with new products and new development that can exploit that and make money, even if the economy as a whole is only puttering along. There's always companies, always innovation, always opportunities to make money in the stock market. You just have to be an investor. You got to realize, I think the U.S. economy is going to do better on a whole 5, 10, 15 years from now than it is today. And if you think that, you should be in the market. And, damn, if the markets go up and down on any given day or year, it doesn't matter. It just matters at the end of the day, you expect to get earnings that will grow with a potential dividend yield, and you will make money. Do not get caught up in beating the market. It's just stupid. It is stupid. It is stupid. It wastes way too much expenses. People spend way too much money on fees to beat the market when they can't. They cannot do it. The average return after fees is less than the market. It's just that simple. That's not debatable. It's not debatable. Is there a guy that beat the market? Yes. Can you pick that guy out in advance? No, you can't. Just because he did it this year doesn't mean he will do it next. You just don't know. In fact, we know pretty factually that the likelihood of that happening consistently is nil, without question. And because of that, forget playing those stupid games. And then got to talk taxes too. If you're buying and selling outside of an IRA, you're paying tax on all that stuff. Forget that. Invest in the companies, a large, broad-based mutual fund, index fund, S&P 500, total stock index, the C fund at the TSP, something like that, and just sit back and enjoy the ride because it could be very profitable for you. Anyway, I'd love to hear your comments about stock market investing. Think about it again in the context of the NFL. Regardless of what the Patriots did, 13-3, the average team was 8-8. Regardless of what the Cleveland Browns did, 0-16, the average team was 8-8. There's just no getting around that. If you factor in fees, the average team is 7-9. Because the fees take away a win and put in the loss, even though the average team was 8-8, the average record. When you factor in fees, it's less than that, which is why you got to watch your fees. Hope this helps. As always, if you like what you see here, go ahead and subscribe. Please subscribe down there. Don't forget to hit the notification bell to be notified of future content. The blog is at heritagewealthplanning.com, and give me comments or questions on the right down there in the comments. I look forward to seeing you next time on the Heritage Wealth Planning YouTube channel. Thanks, guys.